how the assets are getting transferred by way of assignment, or if the both the if the documentation is done in the favor of both the players, then I think assignment is not required. So all these things need to be
Right.
clarified before finalizing in the policy, I think. And
Right.
it is only our interpretation now. We don't know exactly what exactly will be the final outcome of this, final understanding, the what RBI is going to say on this.
Right, sir. So we are now live, sir.
Okay, okay, great.
Yeah. Yeah, good evening, friends. I'm Ashish Agrawal from Resurgent India Limited. I'm happy to welcome to all of you in this today's webinar on the very subject for the financial sector, the co-lending directions 2025 from RBI, and these directions have come very recently. So friends, we have very eminent speakers with us. Those are practitioners in this subject, and they have very good understanding of all the areas. I would like to welcome to Molly sir, who is GM of SIDBI in the refinancing department. So welcome, sir, for us in this program, and thank you for giving your consent to us. Then we have Mr. Praveen Kini. Praveen Kini, sir, is the GM in the Central Bank of India. He is the in charge of co-lending vertical in the Central Bank of India. So welcome, sir, for joining with us in this webinar. Then we have Ms. Sefali Alok. She is the product head in. She has very good understanding of the from the NBFC, and they are having NBFC and HFC both. So they will she will speak on the both the sides actually. So welcome to you, Sefali, for joining with us in this program. And so CV Singh from Bank of Maharashtra was supposed to join. I think he got stuck in some top management meeting. He told us that he will try to join also. So whenever he'll join, we will invite him for his deliberations also. So friends, we have very good panel, and it's a very important subject also. We have very good audience also. The people who are here and those from the audience, all are from the industry itself actually. So we have NBFC captains and treasury heads, business heads, then banks, senior professionals. Then we have consultants also who are practicing in this area, and the technology companies which are part of the ecosystem. They are enabling co-lending in many ways actually. So it's a good forum to discuss and debate that what are the guidelines, how it will impact the overall co-lending practice in the country, whether it will grow faster or it will be on the slow pace, and the views which will we will discuss, or whatever the discussion we'll have. These are the individual views of the people, the all the speakers. There is no with the organizations. That these are the organization views actually. So these are the individual views and their understanding actually. So we are discussing the what can be the possibility of these guidelines actually. So this is just a writer which I want to put to the online session. And so just to give you brief background, the co-lending had started in 2018 actually. It was in the form of co-origination. Then in 2020 on November 5, the RBI came out with the co-lending guidelines as such. And under these guidelines, the co-lending practice was going on. And sometime in the month of, I think, March or April, the RBI came out with the draft guidelines on co-lending. And these guidelines, these directions which they brought with the draft directions. And after three months or months of these draft guidelines, they have come out with the final directions to 25 and the co-lending model actually. So So you see that it's a bumpy road actually. Last 4 5 years, many changes were happened actually, and in the draft guidelines and the current the final guidelines, there are many changes also which were proposed in that actually. So if I see the circular of this RBI new circular, they have tried to make it more transparent and the from the governance point of view also they have tried to cover the many disclosures, many things also. And if you see the initial para of the circular, they have very clearly written that keeping in mind the traction in co-lending actually. So the RBI recognized the industry efforts on the co-lending side. So they have very clearly written that the co-lending has gained the traction. That's why they are issuing the new guidelines also. And they have covered that revised guidelines are comprehensive actually. So from RBI point of view, these are comprehensive guidelines, but being practitioner, it might not be that much comprehensive. We need to discuss in detail actually. So RBI has understood and then recognized the efforts of the industry, and they want it to make it more customer friendly or the borrower friendly and the transparent in the entire ecosystem actually. So we have prepared a PPT, a small PPT, just covering the entire circular in a proper manner. So I'll request my team to just start the PPT. It will help you to understand in a proper manner actually. Yeah, next slide.
You can put in the
So
presentation
friends,
form. I think.
so So if you see that what are the key takeaways or what are the key things are there, these guidelines will be effective from the 1st January 2026. So we have almost from the circular date we have almost 5 months where the industry can take the steps or they can make the corrective measures also. That the on 1st January 2026 we should be ready with the all the changes are required or all technology developments are to be done. Until the time, these old guidelines will continue. That's the objective of the RBI. And if you see they increase the horizon between RE actually. So they have now covered they have said that so it's not like that only banks and NBFC, they can be financial institutions, other institutions also, those are governed by the RBI. They can do the co-lending between themselves actually. So this is one good thing that all India financial institutions are also now covered. And the all loan segments. So this is another icing on the cake that the all kind of loans, whether PSL, non-PSL, secured, unsecured, all are covered under that guideline. So the objective is that the retail lending or the MSME lending should grow. So from point of view, they have clearly written that all kind of loans are covered actually. In earlier circular, that was majorly on the PSL side. So if we see all the tab actually in second and third broaden the scope and the all loan segment. This is very good news for the all the players who are in this industry or who are involved in the co-lending arrangements. And next slide. These are the areas which they have covered and which are the area which need to be discussed here. Actually, we will focus on these areas in the detailed manner. Our panel speakers. So this blended interest rate is the key area which they have covered that the blended interest rate should be charged to the ultimate borrower. So the objective is that the borrower should get some advantage when the two REs are coming to and they are making some co-lending arrangement. That is one area. CLM2. Earlier there were two models, CLM1, CLM2. Although in this new circular they have not written anything that says CLM1, CLM2, but they have some flexibility which looks like that this CLM2 can also be bugged out in the current the new guidelines actually. No MHP relaxation. So this final directions exclude earlier MHP relaxation for the loan actually for discretion in loan takeovers actually. So this is now not there. NPA SMA classification. This is very important point actually when the two REs are joining hands when one is bank, one is NBFC. So if the loan of any RE partner is under SMA or NPA, the co-lending arrangement loan will also be called in the same category. So just to explain here, actually, if you see, banks are having multiple loans, either credit card or maybe the other loans also. So if anything is wrong in the suppose in credit card, and under co-lending arrangement, there is no delay or no default, but this loan can become the SMA or NPA. Because of that, there is a credit card. This is just an example, actually. This is my thought, actually. I will discuss with the panel speaker in detail. So this is one area which need to be seen very, very deeply, that the borrower, the civil and all impact on that, actually, and there may be some operations also. DLG, the FLDG, actually, we see. So earlier there was no credit enhancement was allowed. Now they have said that up to 5% of the money can go paycheck, FLDG, between the partners, actually. So the junior partner can give up to 5% of the FLDG to the senior partner. But this is not clarified that can it be in the form of corporate guarantee, or it can be FLDG means practically this would be in the some banking form. So can it be in the bank guarantee form also, or it can be on the FD back FLDG? So this need to be discussed. On book retention, earlier it was minimum 20%. Now it is 10%. So this will help from the NBFC point of view to utilize their capital in a better manner, actually. So, but this is minimum. Can be anything, actually. Next slide. So these are our views, actually. The borrower to benefit, or RBI motivation that the borrower should get the benefit of the blended rate. We will discuss in detail. And if you see that the blended rate, how the blended rate will help, we'll discuss in detail also. Next slide. Yeah. So I think these are the some detailed clauses which RBI has covered, that no ad hoc charges should be there, additional should be disclosed in advance. So transparency point of view, I think earlier also both the REs were disclosing, but now in the circular itself, these should be informed to the borrower in advance, actually. Yeah, next slide. Asset classification, this is another big area which I have already been I have covered, actually, and reporting disclosure. So both the party should report also. That is another this discussion in the circular. Next slide. Accounting treatment, I think this is a very important requirement, that both the RE should have the accounting treatment according to the applicable law to them, actually. And under this, they are giving that guidelines also, that I think earlier it was akin to DA in the model too. So people were booking the profit in advance for future profits also. But they have clearly written, if such thing is happening, then it will be deducted from the net owned fund, actually. So this need to be seen very deeply from the regulation view. Next slide. So thank you. So friends, this is something which I would like to cover just to set the tone of the discussion, so that we should all be on the same page. And this can be helpful to all of us to understand in detail. Now, I would like to invite panel speakers. All panel speakers are well learned, well experienced, and they are practicing co-lending. So we have Praveen also. Praveen Kiri, sir, welcome to you. We were waiting for you, actually. You are a veteran in this industry, actually. So we have three panel speakers, and two are from the banking and DFI, and one is from NBFC. So it is very well covered panel, actually, we see. Because there are three major partners in this co-lending model, actually. Now, all India financial institutions are allowed, and earlier the banks and NBFC were there. So we can have the views of all kind of institutions. Those are the partners in co-lending. So I would like to welcome you again and thank you to you for joining with us. Sir, if we can understand from you the your initial feedback or your views on that, actually maybe between 2-3 minutes. We'll take questions later on so that the overall objective, overall trend, you have done a lot of discussions, and I was discussing you have created some also to work out the what will be the impact of blended rate. So if you can give your overall views, that will be helpful. So sir, over to you. Yeah, Molly sir.
Yeah, yeah. So,
So sir, you would like to, yes sir, please.
yeah, yeah. So, in fact, we are trying to understand this RBI circular, and we are talking to many players in the industry as well as in with other banks. So, lot many interpretations are coming in. We are also still trying to interpret the circular in a manner which RBI is looking at it. There are certain aspects like right from sourcing of the loan, how it has to be structured, like initial source after sourcing, whether the NBFC will simultaneously give the provide the documents to the bank, and the simultaneous sanction will happen. After that, again, documentation at what level. Documentation will be in the favor of the NBFC, or the documentation will be in the favor of both the NBFC and the bank, and the in what way it will be transferred to the bank, whether it is in the form of assignment, or when if it is the documentation is done in the favor of both the institutions, it cannot be assignment. So all these things needs to be clarified. And coming back to the blended rate currently, the excess interest spread whatever the NBFC is getting, they are keeping it entirely for themselves, and under the accounting norms, they are booking the upfront profit for the entire tenor of the loan. So currently in the new structure, the blended interest rate, there will not be any excess interest spread, and whatever the service charges the NBFC is the cost NBFC is incurring for servicing that, the bank will be paying that separately to the NBFC. And here I think whatever excess interest spread is there, I don't think it will be fully compensated to the NBFC. The NBFC has to curtail its return expectation on this portfolio. Maybe by increasing the volumes, they can make good there. But at a transaction level, the rates of expectation, the returns of NBFCs are supposed to come down. This is one aspect we are looking at it. Mm, Basically, the aim of
So,
RBI is to, yeah, yeah.
sir, at DFI, how do you look at actually, because your role is entirely for developmental of the development aspect from the country point of view.
Yeah, yeah.
So if you can highlight on that also.
Yeah, basically, the intention of the regulator is to bring down the ultimate cost to the ultimate beneficiary, as well as to bring transparency at the level of the customer. So currently, not much of transparency is there at the level of customer, because he may be intimated, but he's not fully aware of who is the actual lender, the majority lender here. So now I think there'll be lot more clarity on that, because at the time of be revealed who will be the lenders here, the NBFC as well as the bank. So to that extent, the information will be shared with the customer. After that, again, every bank and institution has to declare the partners as well as the rates what they're charging. So to that extent also, the information will be shared in the market, like what bank, which bank is giving at what rate, etc. So that much of clarity will be there. But again, like being a bank or any government institution, or even any institution or bank, currently say bank is giving at 9% and the NBFC is giving at 20%. The 20% is being charged to the customer. Now in the blended rate regime, that will not be the case. The blended rate will be charged, and whatever the excess interest rate. Hello.
We can hear you, sir.
So your voice is coming, sir.
Mr. Ashish, you are there?
Yes, sir, your voice is coming, sir. I think you are
Yeah,
very
yeah.
well covered
Yeah,
from
you
your
are.
point of view. One is transparency.
Yeah,
Yes, sir.
transparency and blended interest rate I'm discussing actually. So blended interest rate, now it will be the proportionate amount, like a proportionate rate, blended rate, it will be charged to the ultimate customer. So the NBFC, whatever there he is getting at that in the earlier regime, the excess interest spread, he will not be getting now. To compensate that, the bank will be giving in the form of service charge. So I think to that extent, it will not be fully compensated. There may be some reduction because bank cannot say that we are paying 8% or 9% service charge to the customer. Again, all these things need to be declared upfront on their websites, etc. So there will be some issues on that. How it will work out exactly, we need to see. But these are the basic issues. Again, the customer grievance also currently, the customer grievances all are handled by the branches of the NBFCs. Now, once the upfront, if the customer is knowing that the SIDBI or any other bank, central bank or any other bank is the majority lender with 90% of the portfolio, we expect that more grievances will flow to the banks and other major lenders. So that will be an issue at our level because we don't have that much branch network. It's all centralized at one location for most of the banks. So having the mechanism and having the infrastructure to handle these grievances, that is one of the issues we are looking at. And looking at the way in which earlier it was being done, now it is non-discretionary. Once it is sanctioned, means the bank has to... Hello?
Please carry on, sir.
Yes,
Yeah,
sir.
yeah, it is non-discretionary now. Once the loan is sanctioned, means once the bank has agreed for that sanction and they are given approval for the sanction, they can't have any discretion at the time of disbursement unless any specific issues are there. So that way, I think CLM2 and the difference between CLM2 and CLM1 is coming into effect. Otherwise, they're given 15 days time period for transfer of the assets. So that is a good thing actually. Earlier it was once in a month disbursement. Now I think it will be once in 10 days or once in 1 week the banks will be disbursing. So certain leeways are also there, but again we need to see the finer details, and once the FAQs which are supposed to come from RBI, once that comes, we'll get more clarity on this.
Thank you so much, sir. I think you have covered many points actually. So Praveen Kini sir, welcome to you again, sir. And sir, so you are having very vast experience of co-lending. You are the leader in the market also from the PSU point of view. So it's really privileged to us that you are here to discuss on that actually. But everybody is now discussing many things, but still the ambiguity there. So we would like to understand from you, sir, as a veteran banker in co-lending, what are your views, sir? Overall views on the circular. We'll take the specific questions, I think, maybe after this round. So our participant will know how the banks are thinking about this new circular, whether this will help to grow the business, or this will curtail the business, or this will like that only the bumpy road again and again. Actually, over to you, sir.
Yeah, good afternoon. Thank you, Ashish, and a warm good afternoon to all my co-panel speakers also, and all the participants who have joined today. And I really thank the Insurgent India because of your insights of bringing all this today on this one panel for discussion of the co-lending. First of all, at the outset, let me understand why this co-lending arrangement out of the CLM 1 and 2 has come. So that is the most important thing we should understand, because if you observe when we go to the 2020 circular, and if you find the very basic need of the co-lending arrangement was that the banks and the NBFCs having their different roles, and to bridge them, they had come out with this solution where the unserved and the underserved of the last mile borrower, which has to be reached, and the NBFC had that power, but the issue was about the finance, and which the banks were there to bridge that. But in the end, if you observe last 1 or 2 years, there were a lot of issues, and which had the Reserve Bank had to take cognizance, technically what was happening was the CLM2 was picking up, no doubt about it. But CLM2, what used to happen was that the borrowers had already availed the loan, but when the banks used to fund those loans, 80%, 90, whatever the ratio, some 70% also was there. So you would observe that most of the times this was not being passed on to the borrowers. And technically also it was very difficult, because if you find, it was not possible that it is maybe 4%, 5%, I don't know whether it is more than that. Otherwise, 90% of the borrowers were not getting any benefit of the low rate of interest which the NBFC was taking. So maybe that was one of the reasons where RBI came out with when they sent a draft guidelines, there was a lot of discussions, lot of suggestions. I think so all the banks, all the NBFCs had sent it. But in the end, if you observe, technically, they find a mid path. If you could find, it was similar to CLM1, but also like CLM2, where basically the NBFC is funding the borrowers first, and then the bank is taking the exposure. If you cannot directly rule out that the part CLM2 part is also not there. So they have taken a part of both, and then they have come out with the solution. Yes, definitely, lot of transparency will be there. Point number one. Point number two, yes, the NIM or whatever you call for the NBFCs, that is going to really impact, no doubt about it. Point number three, I feel that though the ratio 90-10 is being kept, but the bigger NBFCs, which I feel, they will be more inclined to have some higher part, like suppose 20 or 30% of their share, because it is possible if there is a prudent NBFC, they will find that the weighted average of, if I do 10-90, it will come down. So to get a better, more share and have a more what do you call that, the weighted average part, because the more their participation of suppose 30 and 70, then they may get a little higher blended rate of interest. So all those things will come into play. It will all depend how the NBFCs find from that part of the angle. And yes, here I again have a feeling that specifically those loans which were we found in the earlier part that the rate of attrition was very high, because what happened, suppose the bank is to give at 10%, the NBFC is to give at 15 or 16%. I am talking about the secured MSME lab or secured housing. Then for definitely for 13%, 12%, they used to take over loans were happening at a very fast rate. So what will happen is that because of the blended rate itself in the beginning, it will come down to directly 11.5 to less than 12 or 11.5. So then those loans will stick. So it will not be that easily those loans will be taken over. So all those plus and minuses are there. Overall, I can feel. But from the point of the transparency part, the reconciliation part, see here the beauty of it is that if you want to go from the this new co-lending arrangement, the most important thing is that from day one your digitally integration is very necessary, because otherwise the reconciliation value is a big issue. So here I think so the biggest challenge for all the banks as well as the partners REs also will be to ensure that the integration part is done on a very war footing basis, because here the biggest challenge lies. Otherwise, if we start the working as in case of what you are doing right now, because most offline we are doing, most of the banks or most of, though we have integrated it, but still with the new concept, if you are not doing it, then it will be most difficult for specifically to match up and also DPD purpose also. So overall, I feel that the RBI has come out taking in care the focus about the really those MSME and the small borrowers to get benefit out of this co-lending purpose, and hence this new arrangement has been brought in the market. So my views are that yes, it will be a challenge. I also would like to see how the NBFCs are reacting, both small and the big NBFCs, because as I told you, that they will be viewing it differently from the blended rate of interest point of view. Thank you.
Sir, thank you so much, sir. Thank you, very sir. As you views actually part of both actually CLM1, CLM2. So ये थोड़ा सा एक तो है कि whether it's a CLM1 or CLM2. So RBI has tried to work out a middle model actually. And large NBFCs, you have given some message to all of us. If you want the better blend from the margin point of view, you should have more skin in the game actually. So it might be the more suitable to NBFCs. And digital is one of the area where you have covered that we should be a digitally acceptable or digitally uh, connected with all these areas for the reconciliation point of view from the day one actually. So that's a good part also. And you lastly you told that how the NBFC will react. So we have uh, from NBFC, I think so now her turn is coming actually. So first of all, welcome to you, Safali. And as Sir has said that they want to know the reaction of the NBFC. So over to you for your reaction or whatever your thought was there actually.
Sure. Thank you so much. And thank you for having me here today. I think overall, this is actually a very welcome change, right? Because at the end of the day, one of the things that most of the NBFCs and HFCs today are doing very well is technology. So while there is a lot of anxiety or fear around, how you're going to manage the operational load that will come out of arrangements, with the new guidelines. I think beyond in an initial teething period with everyone having their API stacks and all of it in place, it should not be something that is a sustainable issue for any of us. I do think that, what the other esteemed panelists were saying earlier, I do think this is a very, very welcome move for the customer, and also in that for the smaller NBFCs. Right. So when you're dropping, the risk retention from 20% to 10%, it continues to allow, a lot more NBFCs and HFCs to actually become participants in co-lending arrangements, allow them to, continue to deploy their capital effectively while still keeping skin in the game. And how I actually see this evolving from a landscape point of view is that it is going to really become about banks partnering with few NBFCs, but those partnerships becoming much more deeper and much more transparent because it will be across different product lines, across PSL and non-PSL. And eventually, companies that are very strong on governance, that are strong on tech are actually going to be, and NBFCs and HFCs are actually going to find themselves in a best beneficial situation at the end of it. There is also this one element, right, which within CLM1 and CLM2, when the blended rate was not actually being enforced, even though there was some expectation of it always. What would end up happening, and we were chatting about this earlier, Chandramouli sir, where a customer would wonder, why am I seeing the logo of a larger bank on my contract who offers rates much lower, but I am being priced at a much higher rate. So that sort of information or understanding asymmetry that would happen would really get curtailed at the get-go, where the customer starts seeing the benefit of, getting that blended rate, which reflects both, both pricing for the NBFC as well as the bank. And eventually, the way that banks work and the way that NBFCs and HFCs work, the strengths are very, very different. Banks at the end of the day are all about the balance sheet strength. They're about the liquidity franchise, and NBFCs and HFCs' strength is distribution. So what I am expecting in this entire setup eventually is we'll continue to see a lot more of such relationships thrive now that there is much more clarity in a lot of areas. This will improve last mile financial access at a rate that is much more affordable for the end user. Once we do have clarity on a few things, which we're hoping to see more about in the near future, I really do think this is a good good circular that has come out, and we're excited about seeing how it starts to get operationalized.
Thank you, Shefali. I think very well covered. And the one thing which we have given this message that the 10% thing can help the small NBFCs to come into the co-lending arrangements also. But
Yes.
you see, these are your views. Actually, if I see from the banker's point of view, whether they will be in a position to the co-lending partnerships with the small partners or not actually.
Yeah.
So, Mali sir, I think if we see the from the market point of view and all, this compliance will increase actually. So this new circular, lot of compliances will increase and all basically. So what do you think that the small NBFCs will get benefit of co-lending, or because now this option is open to all REs, to RE to RE. So the ecosystem will work like that. The large NBFC and banks will tie up for co-lending, and the large NBFC and small NBFC or the fintech will partner with the NBFC, larger NBFCs. So how the ecosystem will evolve, because as a financial institution, you have a limitation actually. You cannot have the hundreds of tie-ups and manage all these tie-ups. So would like to understand your views on that, sir.
Yeah, what I feel is like this 20% to 10%. I don't think it will make much of a difference in the entire scheme of things, because any NBFC want to be a player in the industry, he has to be generating good quality portfolio, and he has to be position himself as a reliable player, create a win-win situation for both the partners. So whether 10% and 20%, I don't think it will make much of a difference. But because 10% is the capital requirement is low, the NBFCs, even smaller NBFCs, can think of becoming a player in the entire ecosystem. So that is one advantage this circular is bringing in. And as you are mentioning, there will be like banks and larger NBFCs. The partnership will increase, and NBFCs and smaller NBFCs, larger NBFCs and smaller NBFCs, and also with fintechs, I think the relationship will improve. Uh, Looking at the DLG guidelines, like 5% DLG. Earlier, there was no DLG specified for RE to RE unless it is a digital lending thing. So now with the 5% DLG, the banks will be more comfortable dealing with the smaller NBFCs also, because they'll be bringing their expertise in the rural areas and limited geographies. With the 5% DLG, I think banks will be looking at that a bit more comfortable. They'll be feeling a bit more comfortable dealing with the smaller NBFCs. Yeah.
Okay, great, sir. So, okay, so if you see, you also told that blended rate actually, because this blended rate for any business proposition, it should be a win-win for all the partners actually. Otherwise, it will not be successful, or it will not go long actually, or it will not grow. So there are three partners in this: the larger RE, or the major contributor, or the NBFC, which is a major minor partner, and the borrower. So if we see the blended rate concept actually, which is still a ambiguity in the mind of everybody, whether how it will be calculated. In the CLM2 model, as of today, there was no blended rate concept. And as you told also, this is a mix of model 1 and model 2. How this blended rate will impact the entire economics of the commercials of the transaction, and whether it will become a feasible option for the banks and NBFCs, or how the NBFC will get the benefit of it actually in terms of the return on their equity actually, because otherwise they will not be in a position to take it forward if they are not getting the margin on that business actually, because they are the source of business actually. They are bringing the customer, all collections, everything. So the cost of this is also there. So blended rate, we go straight, actually, practically there is no advantage to NBFC. So would like to understand from you, you must have done some internal discussion, or your own views also on that, sir. Over to you, sir.
Actually, the blended rate right now, when I was initially also, I was mentioning, like if 10% is the rate charged by the bank, and 20%, if it is a 50-50 arrangement, 20% of the NBFC, then blended rate will be 15%, 15% of the ultimate customer. But again, here the excess interest rate is not there. So the NBFC will be getting its rate 20% on its portfolio of 10%. and the bank will be getting 10% rate on its portfolio of 90%. So now how the NBFC will get compensated? It will be compensated by way of service charge. So service charge now, the excess interest spread is around 8 to 9% being availed by the NBFC. So to that extent, I don't think the banks will be compensating to the NBFCs. And NBFCs, based on their return expectation, need to see which are the areas or which are the products they want to go in for co-lending, and which are the areas and products they want to do themselves. So this is basically the question finally boiling down to this aspect actually. What return expectation the NBFC will be having, and at what rates and what service charge point they'll be able to operate, keeping in line the operating expenses and credit loss being built into the system actually.
Vineet sir, your views on that, sir, if possible.
Yeah, see, to supplement it, I can just say, because I've seen some questions also on blended rate. First of all, to the borrowers, I'll just in a simple format, I'll say, suppose, for example, the for 10%, the bank is funding, suppose 90 for the 90% of the loan, and 15% is being charged by the NBFC for the 10% of the loan. So the blended rate of interest will be technically 10.50. So if it is 20% of the loan, suppose for the RE, so then it may go up to 11%. So up to 50%, it will directly go to 12.5. So I hope so the listeners will be understanding the fact that the weighted average, as I told you. So again, as I repeated, the bigger NBFC, they may come out with solutions for, suppose if they are having, they can go up to 30% also for the co-lending arrangement. Because here now the game, as I told you, because of the weighted average, there the blended rate of interest, suppose for example, in case of 10%, it will be 10.50, and if it is 30%, it can go up to 11.50. So understand that mechanics, what is going to happen. So it will, for all the NBFCs, it will be like, prudently, and they may bucket it, because see here I again repeat, lot of there was attrition among the big NBFCs. They were having good loans. The rate of interest for 0.5 or 1%, they were used to switch over to some other banks or some other NBFC. So here that will have a stop, because now the rate of interest in the beginning itself will be very, very competitive, as I told you. So as far as the blended rate of this is concerned, regarding service charge, what we are saying, yes, there will be also limit to it, because ultimately the GST part will also creep in, and that also has to be factored. So it is not that easy for any, and we cannot go up to a certain limit also, to go beyond that limit for service charge also, where again that cognizance may be taken. But having said that, as ma'am was also saying, it is situation where all the major NBFCs and those who had the NIM part, which said it will be affected a lot. But in the long run, to stabilize the market and to have a transparency, win-win situation for the borrowers, I think so. This model is going to stay, and the blended rate, as far as I understand, I assume that the KFS statement, what we will be giving to the borrower, see, when the NBFC will source, till the time the bank will not give the in principle approval, the NBFC will not be definitely giving the approval to the borrower. The moment it gives, that means the day one, they find that the bank is going, central bank, or for that matter, Bank of India or some other entity. So they will give that joint letter to the borrower mentioning all the facts, what we are saying under the KFS, the statement will happen. And since the bank has already screened it, so the chances of the refusal will be negligible, unless and until, of course, if these some key documents, or if these are some missing or something is there which is not completing the process. In only those cases, that will be very negligible. So, and from the day one where he disburses the loan, he passes on the documents immediately to the bank, which I feel should not take much time, because already they have screened once. And within 1 week, I think so, like monthly initial for the beginning, the 10th, the 20th, and the 30th, some days they should be fixing it, so that the 15 days norms will be definitely adhered to, and before 10th or before 20th as the days whatever is there, and that can be easily attended by the banks, and the norms will be adhered to. Here there was some questions, if not, if those loans then remain in the books, yes, there is a thing that they had mentioned, that it can be used for the your pool buyout as per the DA and all, which comes later on. But in that case, already the letter has been issued. So here that clarification part will be required from the regulator as to how that will happen, or there may be some clause which may be there in case the loan gets stuck up or something for some reason, then your ROI may change or whatever these things may change. So we don't know how that things will shape up. Only for those cases which I feel under the circumstances which will be really negligible if we go through this process. That's what I presume.
Even actually for many things which are in the mind of us actually that ambiguity there. So yeah, operationally told how it will be done actually. So Shefali, come to you. Why co-lending? You can do DA also. So which is more preferable to the NBFCs actually, because you are running HFC also, you are running NBFC also. So whether you'll go for DA or you'll go for a co-lending, which is the preferable mode, keeping in mind the current guidelines?
Yeah, I think what with DA and the requirements of the MHP, in a lot of ways, what we see is that co-lending might actually be more beneficial. And I actually want to also reaffirm one of the thoughts that Sir said in right before I've come on to speak. And eventually with blended rates also, right, what is going to happen is mid-sized HFCs and NBFCs like us, exactly how Sir said, are going to opt for higher shares. So we're not going to operate at the 10%. And then all of the capital that does get freed up for us is what we will deploy to generate the high volume, high yielding products for us. So really, of course, DA has its own benefits. DA is also one of those treadmills that once you get on, very, very hard to get off. We as an organization have always been very, very mindful of that. So we do believe that, as companies scale, it is important to have very strong, robust organic income. And so DA may not be the path that you want to invest in too much. So even from that lens, co-lending, of course, is a much better option than DA would be.
So just to supplement it, please.
Of course, sir.
Mr. Ashish, what?
Yes, sir. Yes, sir. Please,
Yeah.
sir.
See, I'll tell you, I will not be surprised if the DA part is also going to have a drastic changes. If don't be surprised if it happens very shortly.
Okay, so you are saying that there can be alignment in the DA side also, keeping in mind these guidelines. Okay, good.
Absolutely.
Maybe.
Ashish, one more thing here,
Yes,
the upfront booking of income, which is happening currently in the assignment mode, CLM2, what will be happening in the new structure that we have to see, because if it is not assignment, I think we can't book the income upfront for the entire tenor of the loan. So this will be one of the major aspect we need to look into.
So they have clearly written that any upfront bookings would be deducted from the CET1 actually capital jo aapka hai. So in the circular itself they have written actually. So might be a I think disincentive to the NBFCs DA versus co-lending. Because some of the NBFCs are using that tool actually for the profitability and all basically. So sir, I am saying that some NBFCs are this
Your image is stuck,
upfront booking.
Ashish.
Voice is not coming. Hello.
We can hear you, Ashish. I think there's an issue at Sir's end.
Sir's place, I think.
Yeah.
So I think you raised good question. Booking and this might be a disincentive for the NBFCs. Those are looking the booking of profit in advance actually, so they will go for DA rather than co-lending. So this might be like only. And Shefali, would you like to comment on that also?
Ashish, you were breaking up a little bit. Can you repeat
So
that
I'm just
last
saying that
sentence?
this upfront booking of income, it will not be possible in this co-lending model,
Yeah.
because this is the separate arrangement. And so I'm saying that the NBFCs might go for more on DA rather than the co-lending. Only those NBFCs, those are looking the upfront profiting from the profit point of view in the balance sheet, actually, in the P&L.
Yeah, exactly. I fully agree with that. And that's what I was saying, that like at the end of the day, the regulatory landscape for HFCs and NBFCs is also evolving very, very quickly. And we all want to build very high class institutions at the end of the day that work on organic profit, that are actually portraying, the realities of the business that we operate in. So as a practice, like this upfront booking is, the fact that it is going to get moved away is actually a very, very welcome change.
Right, sir. One more issue there, which is we have not covered till now, actually, in this discussion, this escrow arrangement, actually. So they have this in the circular itself. They have said there can be there will be escrow for disbursement. There will be escrow for collection also. So in this new model, how it will work actually? Because they have, suppose if somebody has four RE, four co-lending partners. So which escrow will be used, and how it will be operated also. So or maybe more, you can on that. That will be helpful to our audience also.
I think for each of the partner, we need to have one escrow account, because you cannot operate one escrow account for all the partners. I think it will be different escrow accounts, and it will be system integration from the end to end. It has to be done. Otherwise, first thing is, for any NBFC, smaller or larger here, the system tech backbone is very essential here. Without that, I don't think anything is going to move here, because the strict timelines. Earlier, leeways were not there. Now, 10 days or 15 days, it will be there. But still, unless we have a perfect tech backbone, in the process will not be smooth and it will get stuck. So once that is there, I think escrow account may not be an issue. Escrow account can be different. Escrow accounts can be created and integrated with both the institutions' IT infrastructure, and automatically the things will flow. So I don't see it as a real challenge, actually.
Something that there can be one escrow account for
Ashish, you're breaking up again.
I'm really sorry. There is some disturbance, connectivity issues also. So now it is okay.
Yeah, yeah.
So, sir, sir, I was just trying to just say that somewhere in
We are not getting you, sir.
Your voice is breaking, sir.
I'm really, now it is okay, sir. Hello, coming.
No, no, no,
Your
no.
voice is breaking, sir.
Let me. So, sir, now it is coming. It is unstable. Hello.
Yeah, now
Sir,
it's
it is. So, sir,
Now it's
regarding
better.
escrow account, can there be one escrow account for all co-lending arrangement for the disbursement?
ideally it will be different escrow account for all the NBFCs. That will be the only solution. Otherwise, reconciliation will be a hell of a thing. So you have to have a separate account for each of the NBFC.
One
Okay.
account will not
So,
work, sir.
sir, somewhere they have given the leeway in the circular itself that there can be the one escrow which can be used for other co-lending arrangements also, other CLAs also. So they have clearly written, earlier it was not there. So I think the intention of RBI is that instead of maintaining multiple escrow account, there can be one escrow account also.
Ashish, so
So
typically what we see is it'll be one escrow account for the disbursements, and then there's one escrow account for all of the repayments. Like Praveen sir said, that there is a lot of recon hassle otherwise. So to make that easier, that's how it's usually managed. I would
And for each
assume that that's what will
partner,
happen.
No, we are doing the same thing as of now also.
Yeah, exactly. Yeah,
each partner two escrows. That's what I was saying.
Right,
correct.
right.
what we were discussing that at the moment you are giving the name of one RE, one co-lender, that this loan will go to him. Tomorrow, suppose it will not happen, then suppose it goes to another co-lending partner, then what will happen in that case? We'll the disbursement from an escrow account, from one escrow account actually for one RE, one co-lending partner. So I think this issue RBI has tried to cover up. I'm just seeing the clause, which is the clause in that circular.
Ashish, are you trying to talk about a balance transfer?
No, there will not be any balance transfer. This will be initially that in this 15 days arrangement where you can transfer the loan within 15 days.
Right.
The disbursement, 100% disbursement will happen from the NBFC bank account, actually from the NBFC book actually. And after the disbursement, within 15 days, they can go to the bank and then they can give their portfolio to the bank, and whatever the co-lending arrangement is, either 90-10 or 80-20, this money will be given back by the bank to the NBFC in an escrow account.
Yeah.
This is the arrangement, sir. This will not be the simultaneously disbursement. Otherwise, 15 days, yes, sir.
Same thing, that's what I'm saying. This part will is like akin to the CLM2. Here, though we are the restriction is that it is a time frame of 15 days, but basically it's the same concept. That is, the NBFC is disbursing, then it comes to the bank then scrutinizes, and then it sanctions and opens the account and disburse the 80 or 90%, whatever it is. 80 is prevalent right now, and 90 may be the after 1st January, and that will be the part which will be disbursed to the escrow account of the NBFC.
Correct. So this is the arrangement, new guidelines actually. This should be, ideally it should be like that only, sir.
I think the way that we were reading it, Praveen sir, and would love to learn more from you, but the way that we were reading it, it seemed like the disbursement has to be simultaneous and through the escrow.
That's what
otherwise, for the NBFC, where it is an interest hit, right? Then why the blended rate for the first few days?
That's what I'm saying, no, ma'am. Understand. See, to avoid that, see, basically that is the reason we have told you. If you see why it is said within 50, that means the first day when the NBFC disposes it, his land number is also created. It is entered in his books for the 100%. Then it says it goes to the bank. For that reason also they said it will not be cherry picking. For that reason they said the bank does not have any this to refuse that loans because the KFS is already being there in place and the borrower is being intimated that 20% or 10% is being either shared by Vastu and 80 to 90% is shared by Central Bank of India. So upfront is aware of it that 11.5% is the suppose the blended rate. The 11.5% as I gather will be reported by both the entities. There should not be any confusion. There will
correct.
11.5 the KFS statement what will be given to the borrower, and also it will be in the CIC reporting also both the entities will be reporting the same rate.
Right.
There will be a lot of confusion. It is only between the agreement between the bank and the NBFC, because the bank and the NBFC has a separate agreement where that we will be giving you 30/70 at this point of rate or 20/80 at this point of rate or 10 whatever it is. So once that is decided, and then the NBFC goes in the market to source those loans, and they will, once the documents are collected, they find everything is in order, they put it to the bank. Banks find that is yes, too easy to go ahead. They will give the approval to them in principle, and they go ahead and do the documentation, do the legal technical, and immediately from the day one of the disbursement, from there onwards the 15 days portion will start where the bank has to sanction and disburse the loan in the escrow account of the NBFC. That is the flow of events.
Okay.
In case one query for you, like here when the documentation is happening, the charge will be created in favor of both the lending institutions.
Of course.
In that case, it will not be assignment, right?
Definitely not assignment.
Not assignment. And if any case, if the bank is not with,
the SOP will be stating clearly, the bank will be giving the right to the NBFC for creating that charge on behalf of the that should be the procedure.
Yeah, and in that case, if the bank is not in a position to disburse that loan due to any reason,
exactly,
then what happens?
Where was I coming? See, that is the reason I told you. It will only happen in the case where suppose in the prima facie whatever they have underwritten and sanctioned, and while the production of the documents it is found some anomaly or something, only those accounts will remain, which I feel again it will be negligible and it will have to be tackled one-to-one cases, which I think so the RBI will also have to come out with certain guidelines in those cases what has to be, because already they said in case if the loans cannot be sanctioned by the bank, then it will remain in the books of the originator. That's what they have said. But the other points will have to be clarified, because already
please, sir.
already we have given, as per this, the joint letter will be submitted to the borrower. So in that case, so that's what I'm saying. Here that part will have to be tackled.
And one more thing, sir, here, like at the NBFC, normally 50 to 60% sanctions get converted to disbursements. So,
this is not an issue for us. Na? Whatever the NBFC disburses, which has given in principle sanction by the bank, only those will come to the bank for sanctioning. And
that I'm getting it, but we'll be sanctioning 100% more cases and getting disbursement in 50% of the cases only.
No, that's what I'm saying. We will not be calculating how much, whatever the numbers are coming on 10th or 20th or 30th, we will be setting that date. So within the 15 days, whatever those loans are, it will be an ongoing process. Once the journey starts, they will be also understanding, and like whatever, suppose if they are completing some 10, 12, 13 days before 10th, so they will have to push it on 10th. The remaining loans will go up to 20th, and similarly 30th. So that cycle they will have to start.
What I'm saying is, it may not, the disbursement may not happen because there will be sourcing money. The customer will be given the application to 2, 3, 4 NBFCs. So he may get sanctions from 2, 3 NBFCs and he may avail the loan from one NBFC.
See, that's what I'm saying. Na? If the moment whichever NBFC sanctions and whichever bank is there in the card, the day starts that 15 days from the day of disbursement of that particular customer.
What I'm saying is the number of sanctions, number of volumes will be increasing at our end. Like sanctions will be more and disbursements may be a bit less.
See, that usually happens now also. What we are facing the same thing. There are, for example, one of my NBFC is sourcing 100 loans, suppose for a particular month. What I observed is that 20 to 25% sometimes rejection are there. Out of the 75, another 10% due to some reasons, they don't get disbursed. So remaining whatever 60-65%, those loans which are coming, we open and we disburse and give the funds to the NBFC in their escrow account. We will be giving in principle sanction to them only when they open their accounts in their books, and when they pass it on to us, then only our day starts.
True. Ashish, we are not getting your voice.
Oh, sir, there are some questions from the audience. Are you getting my voice now, sir?
Yeah.
So, questions from the audience, sir. I will just take 2-3 questions. So, somebody has asked, can we sell the 10% amount under DA to another lender?
Sorry?
I think the question is no. Can NBFC sell this 10% portion?
No.
Which
you can't.
They can
no.
actually.
No way.
Because that is the minimum retention.
No way.
And then another question is there, that how does the DLG provision help the originator partner, considering it blocks the portion of their capital until the repayment of the loan? So how the DLG will work actually, because I'll give the 5% DLG to you, then it will remain for the entire tenure of the loan. Then you'll see at some time the DLG will be more the loan amount.
No, that I think so. It will come under FAQ. I think so that will be they should be giving the clarification at what stage though DLG will be relevant, and at what stage it should be diluted.
It should be on the reducing basis, I believe.
My read. Sorry, Praveen, sir. If you were done, I'll jump in.
Yeah, please.
No, so basically it is up to 5%, right? And you have to understand that the NBFCs that are actually going to get into commercial arrangements where it is 5%, they are the ones who are actually looking for co-lending arrangements for, because of limited capital. So when you think of it from that lens, then that 5% more than offsets the fact that they actually are having capital to do disbursements in the first place. So it's not going to be 5% in every single arrangement. And it will again depend on if it is again the large NBFC, large bank, it's going to look entirely different. Ashish, you're on mute.
Sorry, somebody has asked question that is 100% arrangement between two NBFCs. I
Sorry?
think this is no. This is no now because clearly written minimum 10% should be there. Finish, sir, what are your views on that, sir? Or
Sorry?
Safali? Is 100%
No, no.
lending agreement?
No, there is no way. Na. It is said the minimum. That means they said the 10% will be the minimum stake of the original RE. It can increase. It cannot decrease. It cannot come down by 10 from 10%. It can only go above 10%.
Right. Then one more question is from some banker only. Ultimately, the common classification of the account as NPA to be ensured, which implies that all payments of interest and principal are to be pro rata basis. In such, I think what he wrote actually. So he just want to understand कि NPA classification कैसे होगा sir इसका?
Sir, इसके लिए that's what I am saying. Na? The challenge what I wanted to say was that from here in onwards only, from day one when we are doing it, it has to be digitally. Why we are saying is that, and one I will share one thing which I feel will help all to maintain this criteria is that all the collections will be coming in the escrow account of the bank 100%. I again repeat, and the bank will be then appropriating that share whatever 80% or 90% according to the whatever receivables were there. So then only you will be able to maintain that ratio even in the case of the NPA also. And here, the banks and the NBFC have to be on the same page. Like suppose if IPC or ICP, whatever model both of them agree for their particular product, it has to be accordingly appropriate in the same manner. If you do not do that, then again those issues will crop up. So here reconciliation going way forward is most very important. That will help both the regular entities.
Yeah, right, sir. Reconciliation is very important. I think on the daily basis, reconciliation is very important actually.
I'm saying collection part also, it has to route through the escrow account only 100%.
Right. So, sir, I think thank you so much. We had a great discussion. I believe there will be some learning to all of us, not the audience only. Yes, speaker, as a moderator also, we have learned many things by this discussion. And although this is a new circular, so it will take time to understand all the nitty-gritty of the circular. But it will be helpful to all of us with the today's discussion that internally in our system, in our organization, we can debate and discuss and work out on the various policies. Because ultimately, every RE who is interested in co-lending partnership, they have to work out internal policy based on the circular. And as you told Kini sir that FAQ should be there. So we are also a researcher making a FAQ and we are submitting to our RBI that these are the questions of the industry. You please give us the some light on these questions so that it can be in the form of FAQ where maybe 70-80% of the questions which we have today, it might be covered also. So this will be helpful. And you see that currently the industry size is something 1 lakh crore as of today, which has come into media, and the DA is something around 2.5 lakh crore last year securitization. So total market is 3.5 lakh crore, but the co-lending will become very smooth maybe in 1 year or maybe 1.5 years. I think this may surpass the DA and securitization numbers in some years actually. That is my thought process. I hope that all the panel speakers will also have giving the same view. So, sir, if you have any other view also, you can give only maybe 30 seconds on that. That will be helpful to just sum up the session.
Yeah, I think the RBI has come out with a clear circular now, but few of the things needs to be explained or in the form of FAQs or so. I think we'll get a better understanding on that, and I think this is the way to go ahead for all the institutions, whether all the regulated entities. So let us expect that things will smoothen. It will take some time because earlier model also taken 3 4 years time to come to this level of operations. It may take this time. I think it may not take that much of time. Uh, Hopefully, the things will get smoothened out, and the everyone will be benefiting out of that, especially the ultimate borrower.
Right,
Thank
sir.
you, Ashish.
Right, sir. Kini, sir, do you want to give a concluding remark, sir?
Yeah. Once again, I think so. I also like to thank you also and my co-panelists also for their insights into this wonderful debate. Yes, as things will settle down, what I presume, and the FAQs, I think so should not be much, because what I could understand, and if that is being also some directions given by the regulator, and going way forward, again I repeat, it is up to the NBFCs, because as far as, if you see the three players, the banks or the end customers, they that's not, they are going to benefit more, that is the customer. Banks as such, because whatever rate of interest earlier also we are sharing, we will be on the same page. So banks need not have any, this. But only thing is that with the new process and the digital this to be introduced on from day one, to you will have a better clarity, you have a transparency, and reconciliation will be the biggest advantage and benefit in this process. Yes, initially NBFCs will definitely feel the pinch, I know that. But when in the process, what we call the nation building and all, naturally the small borrowers has to be, we have to take their into view also, because of their constraints and the high rate of interest which was charged earlier, which were, you may be aware, I'm not saying about some of the this major NBFCs, but it was a high as 36%, if you are aware of it, which has really shaken up the RBI and the government to come out with certain changes, and for which I feel today we are here discussing the same. So once again, I feel we all should, think about it seriously, and whatever best we can do, we have to go along with it. Thank you.
Thank you, sir. Thank you. We really appreciate your commitment towards this co-lending arrangement. So, Safali ji, would you like to comment or concluding remarks from your side?
Want to thank everyone for the time and for the wonderful insights. I think what I want to say has been echoed already by both Chandramouli sir and Kinney sir, so I won't be repetitive. But I do think that this is a welcome change. I do feel like, given the credit penetration in India, it is still so early days when you benchmark us against, larger developed economies, that not just in the co-lending space, we're seeing a lot better interventions in the fintech space. We will continue to see things that initially might seem like operational disruptions, but in the long run are going to actually enable easier lending, even for us as NBFCs and HFCs. So I look forward to see what kind of partnerships evolve out of this, and in the long run, I think the customer wins, which is the best outcome that we can hope for over here.
Thank you, Sefali ji. So I would like to thank you to all of you, all the panel speaker, Moli ji, Kini ji, Sefali ji, and in absentia, this CV Singh sir, I think he could not join because of some immediate engagement. And I would like to thank you to all the audience, all the people who have joined us, and they have make it more interactive by asking the questions. I think questions were very relevant actually. And I would like to thank you once again to everybody who has participated here, and the Resurgent India team also for organizing this program or this webinar at the appropriate time, because this is a time when everybody is discussing and gossiping that what will happen, what will not happen actually. So this will give some light on the your questions, and it will help you to draft your policies and the future roadmap also. So I believe that with this kind of discussion, we will be in a position when these co-lending will be applicable on 1st of January 2026. We will be having very crystal clear picture in our front. So I would like to thank you once again to all of you and to the Resurgent India team for organizing such program. And we'll keep continue such discussions. And thank you very much to all of you for joining with us. Thank you so much. Thank you, everybody.
Thank you.
Sir.
Thank you,
Thank you.
everyone.
Thanks, sir.
Thank you.
Thank you, madam. Thank you so much.
Thank you.
Thank you, sir.
में बड़ा वो है पॉवर्टी। और मेरा ये विश्वास है कि हिंदुस्तान गरीब देश नहीं है जैसे हमारे पॉलिटिशियन बताते हैं। वी आर रिच कंट्री, मगर हमारे जो लीडर्स हैं वो डाकू चोरी किया है। $1,500 billion of Indian money.
Praveen sir, please stop the screen and recording, sir. The webinar is, you can leave the group, sir. You can leave the screen. Yes, thank you.